So in this video, we're going to look at what will affect the shifting of the exchange rate. So which means the equilibrium point we see in the previous video, how we're actually shifting our equilibrium point. Based on the previous chapter, we understand in order to shifting the equilibrium, changing the equilibrium point, we have to shift the curve. And what we learned from the previous video, we know that the supply curve always be a vertical line, so it won't change at all. So the only thing we will be able to shift will be our demand curve. So in this video, we're going to look at what are the determinants we're shifting our demand curve for the dollar assets. So the determinant, the factor can shift our demand curve of the U.S. asset will be the following: domestic interest rate, foreign interest rate, expected future exchange rate, relative price level, trade barrier, preference for domestic versus foreign goods, and productivity. So actually in our second video of this chapter, we already explained how the relative price level, trade barrier, preference, and productivity gonna affecting the exchange rate. So that's why in this video, we're gonna focus on the domestic interest rate, foreign interest rate, and the expected future exchange rate. So first of all, when we look at all these factors, you have to think about how those factors change gonna affect the demand for the domestic assets, because that's the fundamental reason to shifting the curve. So think about if the domestic U.S. interest rate goes up, and how will that affecting the foreign investors? So yes, foreign investors are more likely to purchasing the U.S. asset because they will gain more interest. So which means the demand for the domestic asset will goes up when the domestic interest rate goes up. To reflect this change to the supply and demand curve, that is what we're gonna see. So when the domestic interest rate goes up, an investor understand it's very worthy to holding the domestic asset. Here we talk about dollar assets. So when the U.S. increase their interest rate, and the demand for the dollar asset will goes up, and then we're gonna see the curve will shift from D1 to D2, and then look at the equilibrium point. So it was 1, now we shift to 2, so which means the equilibrium exchange rate will go up. So when the domestic interest rate goes up, and the exchange rate will goes up. And so look at the for opposite situation, when the foreign interest goes up relative to the domestic interest. So holding the foreign asset is more valuable. So that's why the demand for the domestic asset, the dollar asset, will decrease when other countries of interest rate goes up. So we're going to see the demand curve will shift from D1 to D2, and accordingly, the equilibrium exchange rate will change from 1 to 2, from E1 to E2. Actually, domestic currency will be depreciated. So if you think about the recent what happened for the Federal Reserve, lower the interest rate to help to overcome the COVID-19 natural disaster, and so they lower interest rate in the United States. So what that means? That means the demand for the U.S. Dollar asset will decrease. Actually, we should see the exchange rate of U.S. dollar will decrease. However, you might not see it in between China and U.S. Why is that? Because China might also lower interest rate as well. So here, when we talk about interest rate, we talk about relative interest rate. So foreign interest rate goes up, it's relative to the domestic interest rate. If foreign interest rate goes up, well, we're gonna see the interest rate or exchange rate will go down. So look at the third, is called the expected future exchange rate. So if you're expecting the U.S. dollar will become more valuable in the future, so your current action will be buy more U.S. asset, right? Because if you keep it and you buy $10, but you know the exchange rate will goes up next a few months, so this asset will become more valuable. So that's why when you expect the future exchange rate will goes up, and actually the demand for the domestic goods, the dollar asset will goes up as well. That's why you're gonna see the demand curve will shift from D1 to D2 on this chart. So then accordingly, the interest rate will move or will goes up from E1 to E2, Okay, to summarize everything we learned so far, how will that shifting the curve? And we have this diagram. So first of all, when the domestic interest rate goes up, and then the curve will shift to the right. So the red curve indicating where is the new curve after shifting. So the demand curve will shift to the right, and then accordingly, the exchange rate will go up. So exchange rate go up. When the foreign exchange rate go up, and then what happens is the curve will shift to the left, and because the demand for the dollar asset will decrease. And then accordingly, the exchange rate will go down. And so the expected domestic price level goes up. So which means the dollar get the less, the goods in the United States will become more expensive. The demand for the domestic goods will decrease. So that's why the curve will shift to the left, and then the interest rate will go down. Exchange rate will go down. So expected the trade barrier goes up. And a good. So people will no longer will be freely to buy the foreign goods. So that's why the domestic goods, the asset on the domestic market will increase, and so the curve shift to the right. So demand curve shift to the right, and accordingly the interest rate will go up. And then when the expected import demand goes up, and so the demand for the domestic goods will go down. So the asset domestic will the curve for the demand curve shift to the left, and the exchange rate will go down. So the opposite scenario when the export goes up. When the export goes up, and then the demand for the domestic asset are going to go up, and the curve shift to the right, demand curve shift to the right, and the exchange rate go up. Lastly, the productivity. When the productivity goes up, and then the demand it will causing the demand goes up, and demand will shift to the right, and then we will see the exchange rate goes up. So this is how the curve will shift. So using this model, we are going to analyzing the two scenarios. So the first is during the global financial crisis. So when the start of the global financial crisis in August 2007, the dollar began an accelerated decline in value, falling by 9% against the euro until mid-July of 2008. And after hitting the over all-time low against the euro on July 11th, the value of the dollar suddenly shoot upward by over 20%, and against the euro by the end of October. So what is the relationship between the global financial crisis and this larger swing in the value of the dollar? So think about when the financial crisis happening. So when the financial crisis happened, August 2007, so that means people are expecting the interest rate gaining from U.S. asset will decrease. So when the interest rate go down, that's using the diagram we just learned. So when the interest rate go down, so this is original supply and demand. So when the interest rate go down, what we see in the interest rate go down is the demand for the U.S. asset will decrease to here. So shift to the left. After you shift to the left, you notice that equilibrium point go down. So that's why we see, that's why we notice that at the beginning of the crisis, the U.S. dollar depreciated. And so towards the end of the financial crisis, and people are expecting the interest rate will go up. So the interest of U.S. market on the U.S. market will go up. So that's why the demand curve will shift to the right. Demand curve will shift back to the shift to right, and then the equilibrium point will goes up. So that's why what we're seeing is during the financial crisis, before or during the financial crisis, beginning of financial crisis, U.S. currency depreciated. Towards the end of the financial crisis, and then the interest rate will go up because of economy getting better, and so the demand of asset will shift to the right, and the interest rate will go up. So this is one application of the model we just learned. So let's now discussing our attendance check question, and how do you think the COVID-19 gonna affecting the foreign exchange rate, U.S. dollar against the currency you pick for the bonus of this class? So this is actually a little bit complicated. And then in the short term, and we're going to see the impact of the COVID-19 will be on the productivity of the United States. And so compared with another country, so for instance, currently it seems like all the countries got affected, but compared with the United States and the Britain, if you chose British pound, so it seems like the Britain has the less impact than the United States because they just closed the school, and so they react relatively slower, and it seems like the disease haven't spread that wide compared with the United States. So at current situation, So the productivity in the United States is dramatically decreased compared to US, UK, United Kingdom. So if that's the situation, since the productivity is going down, so based on our analysis, so this rule to the last, the determinant, the productivity. So if the productivity go down, so your demand curve for U.S. assets, the asset denominated in United States dollars, so will shift to the left. So we'll shift to the left. So then the equilibrium exchange rate actually going to go down. So in the short run, you will see the U.S. against the British pound will go down. It is because the productivity in the United States going down faster than the UK. And so this is one potential impact of the COVID-19. And so how about the COVID-19 related policies? So if you look at the United States, they try to stimulate the economy. And so the Federal Reserve lower interest rates, and potentially they might using other monetary policy. So for instance, if the Federal Reserve decide to issue more currencies so that they can distribute more money to each household, if that's the case, the Federal Reserve will creating the inflation. So if the United States is the only country taking that action, so that means the price level in the United States will go up higher. So if that's the case, so we're meeting the third situation, expected domestic price level. So if the domestic price level goes up, the demand curve for the U.S. asset will shift to the left, and then they will decreasing the exchange rate. And so it seems like the both impact from the productivity perspective and from the expected domestic price level perspective, the U.S. currency has a big pressure to become depreciated. And so please use this idea to help you to answer the discussion question of this week, to help you to finish your three student group discussion.